All of the videos you have watched on YouTube up to this point are incomplete. You cannot achieve consistent profitability simply by watching them. The reason for this is simple. If you only mark the high and low of a candle, or focus on liquidity on one side of the market, and then expect price to react without understanding the logic behind it or analyzing anything further, how can profitability be possible? That is exactly why this video is designed to be a fully comprehensive and deeply detailed course. We will go through every CRT model step by step. Each model will be explained in complete depth using ICT concepts. Once you finish watching this video, you will not need to watch any other video related to CRT. This is a promise. Welcome back, everyone. In today's video, we are going to study the monthly CRT model. There is one important thing you must always remember. The market is fractal, time is fractal, and price itself is fractal. This means that a setup that works on the daily time frame will also work on the monthly time frame, the weekly time frame, H1, and even M1. First, we will focus on understanding the monthly CRT model. Then, in the next video, we will move on to the weekly CRT model and the daily CRT model. After that, we will cover the most well-known one, the H4 CRT model. Personally, I prefer the monthly, weekly, and daily timeframes. You should always keep one thing in mind. ICT teaches that smart money operates only on higher timeframes. Institutions and large funds trade primarily on the monthly, weekly, and daily charts. They do not engage in scalping. This is absolutely certain. So now, let's move directly into the monthly CRT model. Guys, I guarantee that you only need to analyze 4 to 5 pairs. As I always tell you, you must do proper marking. If you can get just 2 to 3 trades from this model in a single month, you can easily pass a funded account. You need to ignore everything else and focus only on 4 to 5 pairs. Apply the monthly model on major pairs, and then align it with the weekly, daily, and H4 timeframes as well. You must execute the model on whichever time frame, model, and pair gives you the setup. I believe that if you review 5 pairs daily, you will definitely start seeing this type of trade on one pair or another. So, for the monthly CRT model, the very first step is to open the monthly chart. You must mark the high and low of the previous month. You already know that every candle has a range. We have to mark the high of each candle, specifically the most recent monthly candle. You must clearly mark the CRT high and the CRT low. As soon as the next month begins, we wait for price to purge liquidity on one side of the market. If the market is in a sell trend, you will look to take buy-side liquidity. If the market is in a buy trend, you will look to take sell-side liquidity. If it is a sell-side liquidity run, then you must observe the trade opportunity that forms after that. Here, I am showing you an example. Let's move to the live chart. The market has taken the liquidity of the previous month's low. As soon as that liquidity was cleared, the candle moved upward. Now, we need to observe the third candle. We will focus on this candle. Pay attention to the next month, which will begin after this one. After that, we usually get a very strong high or low forming in this third month. In the second month, our job is to look for the entry criteria. If any setup forms, then we must execute the trade based on it. The advantage of the higher time frame is that when you get a CRT setup on the monthly chart, you usually get 3 to 4 high-quality high or low trades. Once the market clears the liquidity of the previous CRT high or CRT low, we then drop down to the H4 time frame. On H4, you will see smart money distribution. After that, you will see continuation purchase. On the H4 time frame, you must identify a change in the state of delivery. If you get this confirmation on H1 or H4, that is even better. If not, then we will drop to H1 and look for a market structure shift or a change in the state of delivery. Once that confirmation appears, we take the trade. This is the complete roadmap. As I explained earlier, this is exactly what we need to look for. I will repeat it again. First, you mark the previous month's high and low. After that, you wait. Allow the market to clear liquidity on either side. After that, in the third month, we look for confirmation. This includes smart money distribution or continuation purchase on the H4 time frame. Then, you look for a market structure shift or a change in the state of delivery on H1 or H4. If you get it on H1 or H4, that is ideal. Otherwise, you still wait for a market structure shift or a change in the state of delivery on H1 or H4. What is continuation purchase? Do not get confused about this. I will explain this concept further ahead. So guys, this is one example. If you understand this example properly, then you will not face any difficulty when you analyze the live chart. This candle is the previous month's candle, where we have already marked the high, and the low is clearly defined as well. From this level, the new month opened. After opening, the market moved downward and cleared the liquidity of the previous month. After this move, you will start to see a structure forming. You have to observe this structure on the H4 time frame, a simple H4 chart. On H4, your task is to identify the market structure shift. Once that happens, whatever level you have identified at this area, you have to execute the trade using the gap and the change in the state of the order block. Now, let me explain what continuation means. When the market is in a buy trend, price will first move into sell-side liquidity. Even though the market is bullish, retailers usually sell from that area. As soon as the market clears this sell-side liquidity, the market is expected to continue higher. We do not sell the market from the top. Instead, we wait patiently for the market to move down, clear the liquidity of this low, and only then do we look for buy opportunities. So here, the market moved down, and the market cleared the liquidity of the previous low. This means the liquidity has been purged. After this happens, you need to observe the next step. On the H1 time frame, you must look for a market structure shift. Alternatively, on the last down close candle, you should observe the daily close, where an order block is formed. I will show you this clearly on the live chart. This is what we call a change in the state of delivery. I have already explained the change in the state of delivery in detail in a separate in-depth video, which you can also watch. After that, when the market retraces back, you need to form a unicorn model at this level or an A+ model. Both of these entry models are explained on my channel. There is a complete playlist where I have discussed all the entry models in detail. All the entry models that we use in ICT are covered in that playlist. There are 3 to 4 videos dedicated to these models, and you must watch them carefully. Once you go through those videos, all your entry model concepts will become clear. So guys, after watching this video, if you like it, make sure to comment and let me know that you want the next part, which will cover the weekly and daily models. After that, I will try my best to upload that video within one day. And if you have not subscribed to the channel yet, make sure you subscribe to the channel. So this is my monthly chart of DXY. On the monthly time frame, let's zoom into this area. This candle represents the previous month, which is already closed. I have marked both its high and its low. Now my job is simple. I wait for the market to clear liquidity on either side. The new month has opened from this level. The market has cleared sell-side liquidity. This area is now clean of sell-side liquidity. Our work on the monthly chart is complete. Now we move down to the H4 time frame. On H4, or even on the daily time frame, you can observe SMT. After identifying SMT, we plan and execute the trade. This is the daily chart. You can also observe SMT on H4. I open the daily chart because the candles are smaller here, making the example clearer. You can clearly see that the market has cleared the liquidity of this low. When DXY moves upward, we look at bonds. If you type ZB1 on simple trading, you will find this pair. This is the futures chart for bonds. At this time, bonds are moving lower. At the same moment, DXY has moved upward and cleared sell-side liquidity. When DXY cleared the low of the previous month, this was the corresponding high. However, bonds did not clear the liquidity of this high, so DXY created a lower low, while bonds created a higher low. This gives us a very clear SMT. I have a full 20-minute in-depth video on SMT, including a masterclass, which you can find on my channel. This is now the H4 time frame. You can see that after clearing the liquidity of the previous month, SMT is also present here. This was the swing high, the last swing high, and the market closed at this level. This confirms a market structure shift. Now observe this point carefully. As I explained earlier, there is always liquidity above swing highs and below swing lows. Here, you can clearly see this swing low. Below this swing low, sell-side liquidity was resting. The market moved down and purged that liquidity. This is still the H4 timeframe. At this point, we now move down to the H1 timeframe. On H1, we focus on identifying the change in the state of delivery. At this stage, the entire higher timeframe narrative is already clear. SMT is confirmed, monthly liquidity has been cleared, and H4 liquidity has also been taken. The overall bias is bullish. You cannot take entries based on change in the state of delivery everywhere. But when you have alignment from the monthly, daily, and H4 timeframes like we do here, then change in the state of delivery becomes a very powerful entry tool. This candle here was the last selling candle. The market closed above it. This creates a change in the state of delivery order block. As soon as the market returned to this level, this was our trade entry. The stop loss is placed below this low. The take profit for this trade is the first swing high. If you miss this trade, we received another opportunity shortly after. Look here, 1, 2, 3. At this point, the market broke the swing high and shifted structure again. This was the February gap. Along with it, 1, 2, 3 candles formed the order block. These two levels align at the same area. This provided our second trade opportunity. The stop loss is placed below this swing low. The take profit remains the same swing high. If you want to hold the trade for a longer-term target, you can also target the previous month's CRT high. Notice how the market returned, tapped into the order block and the February gap, and then moved impulsively. Within roughly 8 hours, the market reached our take profit. Now we wait again and return to the H4 timeframe to look for the next opportunity. How do we get another entry? The market must clear sell-side liquidity again. Since the overall bias remains bullish, we look for a continuation purge. This continuation purge is also commonly referred to as a Tetris sweep. According to ICT terminology, this represents actual sell-side liquidity. If the market takes sell-side liquidity in a bullish trend and closes above it, we then look for an entry using the change in the state of delivery. Here, this swing high represents sell-side liquidity. When the market takes this liquidity and you see order flow confirmation, you again get a Tetris sweep. This creates what we call a dealing range. A dealing range consists of a high, a low, and then another high. This low has cleared liquidity below the previous low, and this high has cleared buy-side liquidity. From this low to this high, a clear range is formed. Now we apply Fibonacci to this range. We wait for the market to retrace into the 50% level and target liquidity. In this case, the market did not retrace into the 50% level, so we adjust the dealing range by anchoring it from the new high. Now we have a fresh dealing range extending to this new high. Next, we identify where liquidity is resting within this range. Here, equal lows are clearly visible. We now wait for the market to clear the liquidity of these equal lows. After that happens, we move down to the H1 timeframe to plan our trade. The market aggressively moved down, cleared the sell-side liquidity, and tapped into the fair value gap. Liquidity was delivered at this level. Now on the H1 timeframe, you can see that the market left behind a fair value gap. We wait for the market to at least partially close into this gap. Once the market gives a minimum close into the gap, we receive confirmation that price is likely to continue bullish. The market then broke through this gap impulsively, creating another fair value gap. Along with this fair value gap, you can see a sell-side order block that is now turned into a breaker block. Breaker block plus fair value gap gives us a unicorn entry model. If you are not familiar with this, you can find a full playlist on my channel dedicated to entry models. At this point, we execute the trade using the unicorn model. The stop loss is placed below this low. The target is buy-side liquidity, which is the most recent high. You can clearly see how the market reached our take profit within the same CRT cycle. This is the key point I want you to understand. Always follow the higher time frame. Do not repeatedly take stop losses on lower time frames. Higher time frames provide higher accuracy and higher quality trades. Do not think that because this is a monthly time frame, trades will be rare. That is why I told you to analyze at least 4 to 5 pairs. You mark the monthly high and low, and then you wait. you continue monitoring those pairs. As soon as the market clears the high or low of any CRT, you apply the same process and execute the trade. Here on the H4 chart, the market has broken structure to the upside. Now we wait for price to sell into a gap or clear sell-side liquidity. After that, we look for another buy opportunity. In this case, the market did not immediately sell. It continued higher. Later, when the market did sell, this is where your chart reading skill is tested. At this level, there was sell-side liquidity resting at the swing low, along with a fair value gap and a clearly defined sell-side order block. Retail traders who do not understand higher time frame context sold the market here. They saw the high, low, high pattern, change of character, fair value gap, and order block, and assumed a sell. However, during the impulsive move, all of their stop losses were taken. This sell-side order block now became a breaker block for us. When price returns to a breaker block and a fair value gap forms in front of it, we once again have a unicorn model. Before price reached the unicorn, the market cleared sell-side liquidity by taking out this swing low. This created inducement, which was then purged. After all liquidity was cleared, price returned into the unicorn model. This is still on the H4 time frame. Now we move down to H1. On H1, you can see that the swing high was broken and market structure shifted. You can see the swing pattern clearly. Sell-side liquidity is present. Again, we have a breaker block and a fair value gap together. This forms another unicorn entry model. We execute the trade when price returns to this level, placing the stop loss below the low. The first target is this high. The second target is the previous month's CRT high. At this point, the entry is clear. The stop loss is defined, and the target is defined. In one CRT cycle, we achieved 3 high-probability trades. This is the advantage of higher time frame analysis. Many people on YouTube talk about CRT by simply marking one candle and its high and low. If that theory alone was profitable, you would have commented that it works consistently. From my experience, from comments, and from backtesting, using that simplified theory leads to repeated stop losses. Using the Complete ICT-based method breaks that cycle. In this method, I have used SMT, liquidity, higher time frame context, and precise entry models from higher to lower time frames.